because your thesis is that U.S. Treasuries no longer have the dominant position of the global reserve asset for central banks. Now, currently, currently it's 58%. The dollar share of global reserves is at 58% as of Q4 of 2023, according to the IMF. Now, we just started this interview by saying how China is selling its U.S. Treasuries. But beyond China, what do you see happening with central banks to make the U.S. Treasury bond lose its position as king of the global reserve central bank assets?
Yeah, I think the reason why the U.S. Treasury market is losing its share as primary global reserve asset, and we can see that since 2014, global central banks have sold $400 billion of treasuries on net, and they've bought $600 billion worth of gold on net. So from a marginal perspective, for the last 10 years, central banks have bought gold and sold treasuries. The reason I think this is happening is multiple. Number one, for the reasons I just highlighted, some of it's mechanical. When the dollar gets too strong, you sell what you can to raise dollars, not what you want to. That's treasuries. Number two, some of it is geopolitical. Treasuries for central banks are no longer risk-free instruments. If you do something the United States government doesn't like, they will take your treasuries, full stop. They've done it to Russia. They've done it to others. And that has opened eyes. The third point is a little more subtle, but it is in a world where you have peak cheap oil, which is to say we're not running out of oil, but we're running out of cheap oil. It costs more and more to find marginal barrels of oil. When we're in a peak cheap copper world, where again, we're not running out of copper, but the copper we find, the prospective supplies are much, much higher and everyone wants to electrify everything, then you can't store the reserves that you're going to need to, at some point as a nation, deploy possibly into oil, into copper, into commodities. You can't store that in bonds. You need to store that in a reserve asset whose value either stays flat or gains versus oil and copper. And gold has a very long history of maintaining or increasing its value in oil, copper, and other commodity terms. For example, in the last 15 years, oil or gold is up roughly 4x, about 3x to 4x versus oil, and a little over 4x against the Goldman Sachs commodity index. And in contrast, treasury bonds are certificates of confiscation against commodities in a peak cheap copper, peak cheap oil world. Now, if the U.S. debt load was modest, such that the Fed could credibly say we will raise rates as high as we need to in order to contain inflation and keep treasury bonds as good as gold for oil and for commodities, then we wouldn't be seeing this switch, in my view. But the problem is with the debt at 120% to GDP and deficits at 7% with near or full employment, the United States cannot credibly say we're going to raise rates as much as we need to stop inflation. They can't. The United States government can't afford much over 5 or 6% on the 10-year. We know that. We saw it last fall. So if you've got a bond that can only raise rates so much in a world where the geology of copper and the geology of oil and global growth in the global south suggests that the prices of those things are probably going to go up pretty notably over time, then you better store more of your surpluses, more of your central bank FX reserves in a reserve asset, number one, that the Americans can't take, which is gold in your vault, not treasuries. And number two, that preserves your country's purchasing power in oil and copper and commodity terms, which is also gold, not treasuries.
So gold, therefore, becomes the leading reserve asset for central banks. I mean, we have seen central bank purchases of gold at record levels in the last 2 years. According to the World Gold Council, central bank net demand totaled 290 tons in the first quarter of this year. That's the strongest start to any year on record. You're saying that as a reserve asset, gold is going to overtake U.S. Treasuries. Is that correct?
Yeah, it has for the last 10 years, and it's really blown out in the last 2 since we grabbed Russia's, or since we seized Russia's FX reserves. Absolutely. That's exactly what's happening, and I think it's going to continue.
Let's go back to this idea of the dollar being repriced and not replaced. So repriced according to what?
Repriced based on the trading partner's currency. The dollar is wildly overvalued if you want to reshore U.S. industrial production. If that and the mechanics of that really, right, is we consider what would happen if we aggressively rebuilt out our defense industrial base. We would need to run bigger deficits. We're already seeing little symptoms of that with what Biden's doing, with what Trump did. You run much bigger deficits, but again, the bond market, the U.S. Treasury market, is 120% debt to GDP. The United States government cannot abide sustained positive real interest rates without creating this debt spiral we discussed earlier. And so if you want to reshore, you're going to need to have the Fed involved, basically capping interest rates one way or another, or Treasury one way or another, capping interest rates. And doing that will be negative for the dollar, in my view. And so mechanically, how it would work out one way or another, in my view.
Which brings us to the question then, Luke, what is your outlook for gold then? And I believe you said that, well, the timeline for this playing out, I know when we chatted previously, you said by around 2030. Is that correct?
I think that's fair. I think the next 4 years are going to be really something because, again, we've got two presidents. No matter who wins, they're both going to run industrial policy and they both can't run again. So, like, the time to do this is now. And when you look at what is happening with the rate at which U.S. debt and deficits are compounding with the dollar where it is, the fiscal situation is acute in America. And so that also suggests, over the next 4 years, we're going to see a lot of progress on this front. So I do think it's going to be, I think the world's going to look very different when the next president comes into office in 2028.
So let's go 2030, right? Let's have that as our timeline here. What does that mean for gold prices by then?
I think gold has barely, even with its 30% move higher since November, call it, has barely begun to reflect a reversion to the mean that, if I'm right about it, returning to being the primary reserve asset at the global central bank level. It needs to be made orders of magnitude bigger in price. And something I've highlighted before for clients has been the market value of U.S. official gold relative to the foreign held treasuries outstanding. That's simply market price of gold times 261 million ounces that the U.S. owns as a percentage of foreign held treasuries outstanding. And so when we go back through history, what we find is the long-term average of that ratio is 40%, roughly, 40%. In 1989, when the USSR fell, the last time we were in a great power competition or Cold War, whatever you want to call it, that percentage was 20%. And when we had an honest-to-goodness dollar crisis like 1979 and 1980, the percentage was 134%. Now, that is a gold bubble. That meant that foreign holders of treasuries could have showed up at Treasury or Fed and said, give us our gold, and exchanged all of their treasury bonds for gold, and the U.S. still would have had a third of its gold left over. That's a bubble in gold. Fast forward to today, this ratio is at 7%. 7. So gold would need to triple just to get back to the very bottom of this range where we were in 1989, the last time we had a great power competition. Gold would have to rise roughly 6x just to get back to the long-term 50, 60-year average of where it traded in that ratio. And if we, like I said, if we had an honest-to-goodness dollar crisis, gold would have to go up 19x to match the price level it was at in 1980 relative to foreign held treasuries outstanding, which just gives you a sense of exactly how exaggerated the growth in U.S. debt has been and how subdued the price of gold has been since those periods of time.
19x gold at its current price now, only if
That's where it was in 1980. Yep.
Do the math for me, Luke.
42,000, 44,000. Now, I don't think that's going to happen unless there's an honest to goodness dollar crisis, which I'm not foreseeing. But I think the 20 to 40% ratio, right, which is 3x to 6x, like, to me, that's just getting back to the long-term average. That shows you exactly how much debt we have thrown off over the last 40 years. We got very good at exporting treasury bonds and very bad at exporting everything else. That's what that tells you. And what I'm telling you is, who cares what I'm telling you? What Janet Yellen's telling you, what Jake Sullivan's telling you, what the Department of Defense is telling you is that it's a national security interest of the U.S. to get out of the treasury export business and to get into the stuff export business again. But we can't do that without a much weaker dollar. And the arbiter of that's going to be the price of gold, Mike.
Which brings me to an interesting point regarding the gold-oil ratio, because that's something that you've recently posted about, saying that we should think of gold-oil ratio as a pressure gauge on U.S. Treasuries as the primary global reserve asset. Explain that for us.
Yeah, so historically, gold-to-oil ratio, a low gold-to-oil ratio is a healthy, that's a dominant treasury market as primary global reserve asset, because you've got a low price of gold, which means gold is not competing with treasuries as a reserve asset. And you've got a relatively high price of oil, which means there's a lot of petrodollar surpluses being thrown off, flowing into U.S. dollar denominated assets, treasury bonds. So low gold to oil ratios, that's a dominant treasury as primary global reserve asset. Flip it over, high gold to oil ratio means rising high gold price, a lot more competition for treasury bonds as a reserve asset, and or relatively low oil price. And in a relatively low oil price, there's either not a lot of petrodollar surpluses being thrown off to be recycled into treasuries, or worse yet, it's too low and the price of oil is too low, and OPEC plus, et cetera, have to be redeploying their treasuries, selling treasuries to smooth over current account deficits to, fund social programs over there to prevent political instability. So that's why the gold to oil ratio, I think, rising is conveying a really important message, which is, it's at a key level here. It's at 30 or 31. And like almost everybody thinks, okay, well, it's been at 31 before and it rolls over. Except basically every single thing in macro is telling you it's going to keep going higher. You're seeing the BRICS recycle into gold. You're seeing Yellen throw 40 years of economic orthodoxy in the trash. You're seeing the Fed say we're not going to let treasury auctions, treasury market dysfunction. We will add liquidity when it's needed. So I think ultimately, again, nobody trusts the Chinese. And even if they did, China doesn't want to open their capital account and issue debt. They don't want the system the Americans had from 1971 to present. They want to use gold. No one trusts the Russians. They will want gold. The Japanese don't want it, even if they could. They're not big enough. Gold. The Europeans don't want it, even if they could. Gold. So gold is doing what it's doing because gold is taking the place of treasury bonds as a primary reserve asset globally at the central bank level. And as that happens, that's a whole lot of buying against a gold market whose annual production is 240 billion. Look, the oil market globally is like 13 times that annually in physical production terms. That's just the oil market. So if you want to start fitting commodity surpluses into gold, the price of gold is going to have to get a lot higher. And so I think the gold to oil ratio is going to go a lot higher over time.
So Luke, where does digital gold fit into this picture? How does Bitcoin play into this scenario where gold takes over the US Treasury as the primary global reserve asset, but the dollar maintains its status as the global reserve currency? How does Bitcoin fit into this?
I think it's really good for Bitcoin. I look at Bitcoin as an energy-linked neutral reserve asset for the people. The energy link is the proof of work algorithm where you have to spend a lot of electricity to create a Bitcoin and then to continue to spend electricity to maintain the network. And so it is a digital gold-like instrument in that way. When you then layer over what we're really talking about here, which is increasing periods or more frequent periods of increasing dollar liquidity injected in order to finance U.S. deficits because global central banks aren't anymore, they're buying gold. Ultimately, that means more dollar liquidity, weaker dollar. That's good for Bitcoin. So I really like Bitcoin as well. It does a lot of things that gold does, arguably better than gold. But again, it's got a lot more volatility. It's a much smaller market. So I think it's everything we've discussed here is very good for Bitcoin.
Do you see central banks buying Bitcoin as a reserve asset?
Maybe someday when it gets a lot bigger. It's just too small right now. But conceivably, there's no reason they couldn't.
And if the dollar's usage continues, right, and the central banks are buying gold, what role do you see Bitcoin playing as a currency, as a medium of storing value? What is the primary function of Bitcoin in this scenario?
I think it's primarily a store of value, a pristine store of value, a very hard and increasingly hard store of value over time. That can then get into discussions of usage as collateral for other markets, reserve asset usage at some point. Conceivably, you could see it move, so to speak, right, to be used as a medium of exchange. But I don't think it makes any sense, or it doesn't make as much sense to use as a medium of exchange until way down the road when the price is much higher and the volatility is much lower. So for the moment, for the foreseeable future, I just see it as a very hard asset store of value with an energy link for the people.
And what about for the still foreseeable future, that 4.5-year outlook that you have for 2030, where you have your potential anywhere from 3x to 6x to 19x gold? What does that mean for Bitcoin in that time frame?
Bitcoin, I think, probably would go up more than gold would in that scenario on higher volatility. So if gold goes up 3x, I wouldn't be surprised if Bitcoin goes up, I don't know, 4, 5, 6x in that world. So I think they can both win.
But why? Why would Bitcoin be going up? You've made the case for gold with central banks, but why do you see Bitcoin even potentially outperforming gold in the scenario you've laid out?
Oh, that's simple. The $130 trillion bond market is the sucker at the card table, and it's going to figure that out. And as it figures that out, it's going to sell bonds, buy me something that holds value. And then that something that holds value will be 65 trillion of US stocks right now, 14 trillion of gold right now, 1.4 trillion of Bitcoin right now. And that process will continue until the bond selling gets so high that it forces Treasury dysfunction, or it forces rates to a point where the US government cannot afford its debt load. And then the Fed and Treasury will come in and print more money to constrain that, which will only feed back into gold, Bitcoin, stocks, the incentive of whatever's left in the $130 trillion bond market to get out into those other assets faster, wash, rinse, repeat. So there's a way in which this goes without a massive productivity miracle. That things could really feed on themselves very quickly.